Welcome to the debate. Today, we're dissecting a real financial paradox in the Caribbean. We're analyzing the 2024 annual report from Margaritaville Turks Ltd. That's ticker symbol MTL. And on the surface, this looks like a massive success story. The cruise ships are back, the port is packed, revenue is climbing. But when you start to peel back the layers, you find that profits have seemingly, they've evaporated. We're looking at a company that sells island escapism, but, it operates in a brutal inflationary reality. So the central question we're debating is this. Is the collapse in profit a temporary stumbling block before a record-breaking recovery, or is this business model structurally broken, destined for a profitless prosperity, where the company just works harder for less money?
Profitless prosperity is exactly the right framing. I look at this annual report and I see a hollow company. The lights are on, the blender's running, the music's playing, but the value for the shareholder is just being siphoned off, both by the macroeconomic environment and, frankly, by the parent company itself, through some, let's say, questionable governance.
And I'll be representing the bullish view, or maybe more accurately, the turnaround view. I see a company that survived a near-death experience during the pandemic and has now, I think, fully stabilized. The 2024 numbers show a massive surge in volume. We're talking nearly 1 million passengers. The kitchen is running leaner than ever, and if you look ahead to the Q1 2025 data, we aren't just recovering, we are entering a new era of, record profitability. The shock of inflation has been absorbed, and the machine is printing money again.
And I'm taking the bearish view. I see a company running on a treadmill that just got turned way up. Revenue is up, yes, but net profit collapsed by 60%. They are working significantly harder for significantly less money. Between the government-mandated wage hikes, exploding insurance premiums, and a balance sheet that raises some really serious red flags about where the cash is actually going, I argue that the so-called recovery is a mirage. The underlying economics of this business have deteriorated.
Okay, so let's start with the top line, because you can't have a business without customers. Fiscal year 2024, ending May 31st, was the year the crowds really returned. Revenue hit $7.84 million. That's nearly an 8% jump year over year. But the real story is the foot traffic. We have 990,035 passengers who walked off those cruise ships and into the Grand Turk Cruise Center, a 13.1% increase. We are within, 7% of the all-time high set back in 2019? The demand problem is solved. The customers are there.
I'll grant you that the ships are docking. The volume is there. But in this specific business, volume can be a trap if your margins are deteriorating. You mentioned revenue is up 8%. Wonderful. But let's look at what actually matters to an investor. Net profit. It fell from $1.67 million in 2023 to just $657,000 in 2024. Earnings per share collapsed from nearly 2.5 cents to under 1 cent. That is not a stumbling block. That's a nosedive. The company captured more people, but kept less of their money.
But you have to contextualize that drop. 2023 was a bit of an anomaly. It had some non-recurring benefits. But more importantly, look at how management handled that volume. In the restaurant game, the cost of sales, essentially the raw cost of your food and tequila, is the only thing you can truly control day to day. In a year where global food inflation was rampant, MTL lowered their cost of sales ratio from 30.85% down to 29.44%.
Which is a credit to the kitchen manager, sure.
It's more than that. It is a massive indicator of operational discipline. A 1.4% improvement in food costs on $8 million in revenue is the difference between red and black ink. It means they're buying smarter, they're wasting less, controlling portions. They have proven they can manage the microeconomics of the restaurant perfectly. They are squeezing more margin out of every single burger sold.
But they're failing the macroeconomics test. That 1.4% saving on limes and burgers is being completely, utterly swallowed by the costs they can't control. This is the definition of negative operating leverage. Revenue went up 8%, but admin expenses jumped nearly 20%. This is the cost squeeze I'm talking about. The Turks and Caicos government raised the minimum wage by 28% to fight inflation. That's not a one-time fine. That is a permanent resetting of their labor cost base. And of course, because they want to maintain wage parity, they had to give raises to the senior staff too.
Which is a sunk cost now it's baked in. The shock happened in 2024.
But is it just a shock? Labor is just one pillar. Look at insurance. Property insurance premiums skyrocketed by over 70%. We're talking about an increase from, $116,000 to $195,000 in a single year. We're in a hard insurance market globally, especially for hurricane zones. These are sticky costs. Insurers aren't going to suddenly lower premiums next year. So you have a business model where your fixed and semi-fixed costs are rising much faster than your revenue can catch up. That is a structural problem, not a temporary one.
I disagree that it represents a permanent negative operating leverage. It was a step change shock to the system, yes, but the business is adapting. You're looking in the rearview mirror of 2024. I'm looking at the windshield of 2025. The Q1 2025 results, covering just June to August 2024, show that the volume has finally outpaced those new costs. They had 355,000 passengers in 3 months. That is the highest quarterly volume in the company's entire history.
It was a good quarter, I won't deny that.
It was a spectacular quarter. Revenue was $2.53 million. Profit was nearly $400,000. If you annualize that, they're on track for $1.5 million in net profit for the year. That puts them right back to pre-pandemic profitability, despite the higher wages and despite the insurance. The volume leverage is finally kicking in. The machine is working.
If, and it is a massive if, that volume holds. But this brings me to the fundamental flaw in your volume thesis, the yield problem. You're celebrating that the port is packed. I'm arguing that a packed port is actually becoming less profitable per person. Look at the spending per head, or SPH. It dropped from $8.29 to $7.92.
A 37-cent drop is hardly a crisis. It's noise.
It is a trend. And the annual report explicitly admits why. It says, and I'm quoting, "As passenger totals increase beyond an optimum total, there may be a reduction in spending rate." This is congestion risk. When 4,000 people get off a methaship, the pool gets crowded, the bar lines get long, service slows down, people get frustrated, and they don't buy that second drink. There is a physical limit to how much revenue this footprint can capture, and I think they've hit it. The efficiency you praised in the kitchen doesn't matter if the customer can't get to the bar to order.
Well, that would be true if the footprint remained static. But management isn't blind to this. They're expanding the capture area. In April 2024, they opened additional satellite bars. They opened up beach areas that were previously closed off because of security concerns. They're spreading the crowd out to reduce that friction. They are physically altering the venue to mitigate that very congestion risk.
They are scrambling to defend their turf. The report notes that Carnival and the local government are actively pushing passengers to go on excursions away from the port. They're encouraging competition. So MTL is fighting a war on two fronts: internal congestion that reduces service quality, and external partners trying to siphon passengers away to local tours. That explains the drop in spending per head. It's not just congestion, it's leakage.
I see the excursions differently. A boring destination kills a cruise port. If Grand Turk is just Margaritaville, people stop booking the cruise. The excursions keep the destination fresh, which guarantees the ships keep coming. And let's talk about those ships. 80.3% of the passengers are from Carnival Corporation. This is a captive audience. The average ship now holds, 3,750 people? These are floating cities. MTL doesn't have to market itself, it just has to open the doors. That is a strategic moat that very few businesses have. You're worried about leakage? I'm looking at the fire hose of customers Carnival is pointing directly at their front door.
It's a moat, but it's also a single point of failure. If Carnival changes an itinerary, MTL is finished. But let's move away from operations for a moment, because even if they sell every margarita in the Caribbean, it doesn't matter if the cash doesn't reach the shareholders. We need to talk about the balance sheet, specifically the related party transactions. This is where the story gets dark for me.
I had a feeling we were going there. It's a conglomerate structure. This is standard practice in the Caribbean.
It's standard practice for private empires, perhaps, but for a public company with minority shareholders, it is alarming. Look at the line item due from related companies. In 2023, it was $2.2 million. In 2024, it ballooned to $3.73 million. That's an increase of over $1.5 million in a single year.
That represents the group's central treasury management. Margaritaville Caribbean Group moves liquidity where it's needed.
Okay, let's translate that. MTL, the entity we are discussing, generated cash. Instead of keeping that cash in Grand Turk to pay dividends or reinvest, they lent $1.5 million to their parent company or their sister companies, and here's the kicker. The report states, these amounts are interest-free and unsecured with no fixed terms of repayment.
The group supported MTL when revenue was zero during COVID. Now MTL is supporting the group. That's the benefit of being part of a larger ecosystem. It is a symbiotic relationship.
That is not a benefit to the minority shareholder who bought stock in MTL, not the parent group. Think about the opportunity cost. Inflation is high. Interest rates are high. That $3.7 million could be sitting in a treasury bill earning 5%. That would be nearly $200,000 in pure profit. It could be paid out as a dividend. Instead, it's just sitting there as a dead asset, eroding in value due to inflation, earning zero return for MTL shareholders. It is just bad capital allocation.
But the company is still solvent. Look at the total assets, up to $6.77 million. Shareholder equity is up to $4.63 million. You're making it sound like they're insolvent. They're asset rich.
They are paper asset rich and cash poor. Cash on hand dropped to just $28,780. A public company generating $8 million in revenue has less than 30 grand in the bank. Why? Because they shift all the liquidity up to the parent company. That's why they didn't pay a dividend, not because they couldn't, but because the cash literally wasn't there.
You're ignoring the other side of the ledger. They didn't just lend money, they paid off debt. The long-term loan from the Grand Turk Cruise Center was paid down from $186,000 to just $58,000. They have effectively deleveraged the company from external debt. That reduces interest expense and strengthens the balance sheet long-term.
They paid off a low-interest loan while lending out millions for free. That is terrible math. It screams that the management prioritizes the parent company's needs over the subsidiary's shareholders. It makes MTL look like a piggy bank rather than a standalone growth story. Why would you pay down cheap debt when you have millions sitting earning zero interest somewhere else?
I think piggy bank is harsh. It's a mechanism of survival and group stability. But let's look at the financial health holistically. Total liabilities are only $2.1 million against $6.7 million in assets. The ratio is healthy. And most importantly, the core business, the engine that generates the cash, is roaring. You can argue about where the cash sits after it's earned, but you cannot argue that the engine is broken when they just posted a record Q1. The operational reality is winning.
I can argue the engine is sputtering if the spend per head keeps dropping. You are banking entirely on the idea that volume will mask the inefficiencies. But what happens if the U.S. economy slows down? What happens if that $7.92 spend drops to $7 because passengers are tightening their belts? The margins are already razor thin because of the insurance and wage hikes. They have no buffer left.
But the data suggests the opposite. Carnival is reporting record bookings for the future. The pipeline is full, and the destination itself is safer. The report highlights the new port access guidelines implemented in August 2024. Security is tighter, the environment is better. That keeps Grand Turk as a premier stop.
Security is better, sure, but the competition is fiercer. The local businesses are hungry. The congestion risk is real. If I'm a tourist and I see a line of 50 people at the Margaritaville bar, I'm walking to the local shack down the beach. That is leakage.
And that is why the satellite bars are so critical. They are capturing that leakage. And the Q1 numbers prove it's working. You're worried about a hypothetical decline in spending, but the actual show $400,000 in profit in 3 months. That is hard data beating a bearish theory. The satellite bars are working. The beach access is working. They are monetizing the volume.
One quarter does not make a trend, especially a quarter that includes the summer travel peak. Seasonality plays a huge role here. The real test will be the shoulder months. If they can maintain that profitability when the ships aren't 100% full, I might change my mind. But as long as that due from related companies line keeps growing, I see a governance discount that makes this uninvestable for me.
And I see a company that is currently undervalued because the market is looking at the 2024 dip and ignoring the 2025 surge.
They've swallowed the poison pill at inflation, the wages are paid, the insurance is bought, and they're still standing.
Standing, yes. But moving forward? That depends on whether they decide to return cash to shareholders or keep lending it to themselves.
So, we have two very different portraits of the same island. To summarize my position, MTL has successfully navigated the post-pandemic chaos. They've locked in operational efficiencies with that sub 30% cost of sales. The passenger volume is back to near historic highs, and the record-breaking Q1 2025 profit proves that the business model works even with the new cost structure. The recovery is real, and the growth phase has begun.
And to summarize my view, we're looking at a classic case of profitless prosperity. The top line looks great, but the bottom line has been gutted by structural inflation in wages and insurance that isn't going away. The spending per passenger is in decline due to congestion and competition. And most critically, the cash the company does generate is being trapped in related party loans rather than benefiting the shareholders. It's a risky bet on a business with zero pricing power.
It really comes down to whether you believe the volume can outrun the costs, or if the costs have permanently eroded the margin.
And whether you trust the management to treat your money as their own or as a loan to the parent group.
That is for our listeners to decide. We will be watching those Q2 numbers very closely.
And the cash flow statement.
That does it for this edition of The Debate. We will see you next time.